Hey everyone, AI stocks are absolutely on fire. So in this video, I'm going to compare two semiconductor slash AI stocks that I think make a good comparison to answer which one is the better buy, Nvidia or Taiwan Semiconductor Manufacturing. Interestingly, Taiwan Semiconductor is a supplier to Nvidia, so it's an understanding which one is better, right? Go with the supplier or go with Nvidia. Let's look at this question in this video.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the first thing we're going to compare these two on is revenue. And you can see here that Nvidia has outperformed Taiwan Semiconductor in terms of revenue growth in the recent year. However, the total revenue is much higher for Nvidia at 69.33 billion. But look at this explosion from Nvidia in the recent year to 44.87 billion. Now, since I mentioned that they're related, TSM supplies Nvidia, so if Nvidia's revenue continues exploding like this, TSM is likely to follow. And we're going to see the prospects going forward, which one has better revenue and earnings per share prospects for the next 2 years. So both Nvidia and TSM demonstrate economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from $100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. So now that you understand what economies in scale are, you can see TSM and Nvidia increasing their operating profit margin as their revenues have increased. They're both similar here, 45.94% operating profit margin for Nvidia and 45.62% for Taiwan Semiconductor. So they're neck and neck here in terms of operating profit margin. But again, Nvidia is showing the stronger growth, the stronger explosion here in this metric. Looking forward for the next 2 years, you'll see that Nvidia has explosive revenue growth expectations. For its fiscal year 2024, revenue is expected to grow by 60% and then in 2025 by 19.6%. Earnings per share is expected to grow by 72% with 19.5% for 2025. For TSM, for fiscal year 2024, 20% revenue growth expected with 10% earnings per share. For 25, 20% revenue growth and 22% earnings growth. For 2026, 13% revenue growth and decreasing earnings per share. So its prospects are nowhere near those of Nvidia, which is expected to continue thriving over the next 2 years. I also want you to understand the importance of cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. the company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you understand the importance of this metric, you can see TSM leading Nvidia in this metric, 63.15%. That's a really strong CFO to sales ratio. I wouldn't be surprised if that's on the top of my list of all the stocks that I follow. Visa might be close. I'll have to check again with Visa's latest update, but this is right up there with the best of the best in terms of CFO to sales. Nvidia is also really good, but it's trailing TSM with 41.99% cash flow from operations to sales. And finally, I wanted to compare valuation, and I chose to use the forward price to earnings ratio. And according to this metric, Nvidia is more expensive than TSM. Nvidia is trading at a forward PE of 29.34 compared to a forward PE of 16.78 for TSM. Now, if I was to choose one of these two AI stocks today, I feel Nvidia has earned the premium, and I would choose Nvidia as the better AI stock to buy today. Given its better prospects over the next 2 years and given the lower geopolitical risks from Nvidia, I would prefer Nvidia over TSM, but they're both excellent companies. It's just TSM has a higher geopolitical risk with its relationship in Taiwan and China, and how those risks could play a role in how investors perceive TSM stock and their unwillingness to give it a premium valuation, versus Nvidia, which doesn't face those risks or not as much geopolitical risk. It still has some, but not as much. So for those reasons, I would go with Nvidia as the better AI stock to buy today. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.